Hey everybody, it's Deanna and I am here today, Fearless Entrepreneurship Live with another special guest, Paul Whitehouse from Patriot Business Financing Consultants. And Paul and I, we go way back. Paul and I used to work together in another life and I'm so excited to bring him on. How are you, Paul?
I'm good. Thank you for bringing me on. I really appreciate it.
No problem. No problem. I know we reconnected. We're friends on Facebook, reconnected on LinkedIn. And when I saw that you do business financing, I'm like, oh my goodness, like I need to talk to you because that's a question that I get asked a lot from a lot of startups and small business owners, right? They may do things on a very limited budget, but then they get to a point where they want to start to finance or they need to finance and either to buy equipment or location or whatever it may be, and they don't know where to start, and it gets a little overwhelming and it gets intimidating. So I'm hoping that you can answer some questions and just talk to us a little bit about when you do need financing as a business owner. So tell me a little bit about what you guys do.
Well, so we represent 105 specialized lenders. And when you said intimidating getting financing, yes. And then, what happens if you get turned down? Then what direction do you go? So they just don't know that there's other sources other than the local bank. You know, we have 105 lenders that we represent, and they're all specialists. What I mean by that is some of the leasing companies that we represent, they will only do business in the construction or the trucking industry. They won't finance medical equipment. But then we've got other lenders who only finance medical.
I think you're frozen here for a second. You are frozen. I don't know if I'm frozen too, but let's see here. I'm going to just keep chatting until he unfreezes, unless I'm also frozen as well. Are you back?
I'm back. Yes.
You froze up on me, so I'm like,
Magic.
okay,
I'm back.
where's Paul go?
So what I was saying was 105 lenders that we represent, and they all are in different fields. They're specialists. So they're going to put together a better deal structure. They know the business that you're in, so they'll put together a deal structure, a better term, better rate, and they want us to make ways to say yes. So, and that's what we do as consultants is we listen to what you need, try to figure out the best plan, present it to you, and then take you to the best lenders to go with.
So if I'm launching a business, let's just say I'm opening up a restaurant. We're going to start there, right? I'm opening up a restaurant. What do I need to be prepared before I even call you? Like, what are you going to need from me?
It's pretty funny that you asked me that because I have a good friend of mine, Matt Deedle. He won't mind if I say his name. He's a great guy. So he's going to open a restaurant in Warren. And the route to go if you're now there's, if you're a startup business, that's one route. If you're an existing business, that's easier to get you the financing that you need. But in his case, he's going to put 20% down, and we're going to go through the SBA to get him an SBA guaranteed loan on that. It's kind of on hold right now because the SBA is not lending in the restaurant industry right now.
Oh, wow.
Yeah. So Matt,
everything going on, I'm assuming. Okay.
That's exactly right. Yeah. They shut it down. So he's on hold. He's patient. He's a friend. But what he brought to us was a business plan, the construction plans, the cost of everything, and how much money is he going to put down, and what type of equipment do you need. And then we package it, send it to the lender who's going to do it, because there are, like, every bank can participate in an SBA loan program, but if you're going to do it, you might as well go with like a specialist. There are SBA lenders who are not depository banks, and the only thing that they do is lend in the restaurant business or lend in the construction industry. So that would be one example, a startup business to open a restaurant. Other examples would be, and easier examples, if you're an existing business and you've been around for 2 years, or 2 years is usually the minimum, if you needed a piece of equipment for your business, restaurant equipment, manufacturing equipment, trucks, whatever, that's super easy to do. Those things can be completed in like 2 weeks.
Oh, wow.
Where with this restaurant deal we're working with my friend, that's going to take 2 months. And that's okay. It's time frame. It's his time frame, and we're good with whatever time frame, but that's the difference. A brand new startup business is one avenue and one level of difficulty and level of documentation that you have to present. And then others would be, if you're an existing business, then it can be done in 2 weeks.
Wow. That's great. I mean, because I think of a lot of businesses that they've been in business, right? But they are looking to like upgrade a piece of equipment or to add a piece of equipment just to make their business run a little bit more efficiently. So
yeah,
that's
right.
good that turnaround time could be just as short as a couple weeks.
Yeah.
So we had talked about equipment leasing, right? And I may get all this wrong because this is not my forte, and I'm not going to pretend that when it comes to banking and finance that I'm thoroughly versed in all of the terminology. I'm not. Like, I count on all of you guys to educate me on this. But we had talked about equipment leasing, right? Explain what that is.
Well, equipment leasing is the best way to get equipment for a business. Here's why. Like, following example, the biggest companies in the world, they don't spend cash, they don't use a line of credit, and they don't use working capital. They lease the equipment. And when you say leasing, a lot of people instantly think, well, I make the payments, but I never own it. I turn it back in.
Right.
That's true if it is a piece of equipment that becomes obsolete and you're going to want to get rid of it. That's called an operating lease, because there's two different types. So, and on that subject, if you have an operating lease, the benefits of that are, that's a long-term rental that you can write that whole payment off on your taxes. But the flip of that, there's something called a capital lease, and you go into a capital lease with the intent to own the equipment. So let's say it's manufacturing equipment, restaurant equipment, a bulldozer, a semi-truck, things that are durable and you're going to want to keep.
Yeah.
So you lease it, and at the end of that lease, you buy it out for $1, and you get the advantage. Because you got a couple ways a business owner can do it. They could pay all cash. They could bank finance it, but if you bank finance it, they're going to want 10 or 20% down. But if you lease it, you can do 100% financing, not a problem. You get the tax advantages. If it's a capital lease, you write off the interest on the payments. So you're not paying interest, essentially. It's crazy.
So let me just repeat this back to you. On an equipment lease, I give the equipment back at the end of the lease. The term is up, and then you take that back, but I can write off that lease payment. On a capital lease,
yeah, that's right. On an operating lease, which is something that you're going to want to turn back in, then you write off the whole payment, you get the equipment, then you get the next greatest thing, the update. But if it's something durable, like a semi-truck or a bulldozer or restaurant equipment, then that's called a capital lease, and you make the payments, and at the end of those payments, you just buy it for $1.
And my write-off would be the interest. So I'm not really paying. I'm writing off the interest on that.
Yeah, that's right.
Pretty good options. And I guess and I'm thinking in mind, a lot of my equipment that I would purchase, right, would probably be more of the equipment lease, because by the time it's paid off, it's probably outdated and you need more. You need the latest version of whatever you're using.
Right. The latest and the greatest.
Right? So what other type of programs do you have there?
Well, literally with 105 lenders, every program, any business finance need that they have, we can fulfill. Whether it's working capital, SBA loans, the equipment leasing. One way to raise working capital is through something called a sale leaseback, which is an equipment lease, again, going back in that direction.
Okay.
So here's an easy example. I keep going to the construction and the trucking guys, but it's just easy.
Yeah, that's all right. It makes
Yeah,
sense. I mean, there's a lot of people that do that, construction and
yeah,
roofers, builders, whatever, right? I mean, that encompasses all of them. So,
yeah. But it will work any industry, any business. That's our motto. Any state, any industry, any equipment, any credit. But a sale leaseback, let's say you got a guy who owns, he's got a construction company, he's got 4 or 5 big pieces of equipment, and he needs to raise X amount of money for working capital. He can
okay.
literally, if he has a zero balance, he owns that equipment free and clear, or if he's got a low balance on it, there are leasing companies that will come in, they'll buy that from him, they'll give him the money he needs for the working capital, and he leases it. It's a simultaneous signing. He will lease it back from them, the same piece of equipment that he just sold to him. He leases it back from them, makes the payments, and at the end of the payments, because his goal was to never get rid of the equipment, his goal was just to get some working capital, right?
Okay.
At the end of the payments, he buys it back for $1.
Wow. And
Yeah,
wait, what is that one called now?
that's called a sale leaseback.
A sale lease. So what's the difference then? What's the biggest difference between that and the capital lease? Well, the capital you don't buy back for $1. Oh, yes,
Well,
you do buy the capital for $1 back. So what's the biggest difference between those two?
the difference is for the equipment leasing, there's operating lease and a capital lease. Whichever one it is, it doesn't matter. But for an equipment leasing, you're a business owner and you want to get some new equipment. It can be new or used equipment, but you want to get another piece of equipment. So
Okay.
you pick out the equipment, you get the price on it, we do the paperwork, and you're getting new equipment. But the sale lease back, that's equipment that you already own and you're
Oh,
selling it. You're selling it to the leasing company, which gives
I gotcha. I
yeah,
gotcha.
and that
God,
gives
that's
you working
confusing.
cap. What's it?
I said, God, that's confusing.
It gets simple.
Well, I'm glad you get it. It's like, holy
Well,
cow.
if I get it, anybody can get it.
There's a lot to really know. I mean, honestly, on your end, you're obviously guiding the small business owner or the
Yeah,
business owner, right, in which
totally. That's
program is
our
the best. But
yeah.
there,
We're consultants. That's our job. We consult, pick the best program. We listen. What do you need? What are you trying to get done? And then we say, here's the path. Here's the best path, and here's the best lender to go with.
that's good. That's great to have somebody in your corner guiding you. I know I would be overwhelmed. I mean, just hearing like a little tidbit of what type of programs you have, it's like, wow, I had no idea. There were so many different ways.
There's so
In
many
my
ways to
mind,
go.
I always thought like, okay, if you need a loan, you go to the bank, you apply for a loan. They of course want to see your business plan, want to see probably, your financial records, and then they tell you yes or no. But here you're like, no, there's so many other options and ways to get.
Oh, it's a wide open world because just remember that Progressive commercial. They'll tell you everybody else's rates.
Yeah,
Okay, well, kind of the same thing. If you go to the bank, if you're going to the bank to get a mortgage, they're going to tell you their programs, their rates. And if you don't plug into that, then you're out. You're either
yeah.
in or you're out. But if you go to a mortgage broker, they've got like 30 or 40 banks, right? And they're going to find somebody who will say yes because they might be more lenient. There's more choices, more programs. We do the exact same thing, except it's not residential mortgages. Our programs are every form of business finance, an SBA loan, ways to get working capital, equipment lease financing, cash flow programs, which is called factoring, and
Yes.
even consumer financing, business to consumer financing. If you're a retail business and you're not offering financing, you should, because you're losing sales.
Talk a little bit about that. What is that exactly?
Okay, so anything retail, business to consumer. You can be the guy who's coming in to sell a roof, to sell home additions, a jewelry store. I mean, anything you're not going to sell pizza like this, but anything that,
Yeah.
a higher ticket, and you might have to finance it. So, you go to the jewelry store, they offer financing. If it's the same thing, and we can set you up. If you own a jewelry store, if anybody here is listening and they own a store and they don't offer financing, we can arrange it for you. It's easy to do. And the way it works is this: with the company that we represent, once you're signed up with them, you'll receive a program called Oasis. It's online instant approval system. And like I said, it doesn't matter what business, you can be selling roofs or jewelry, but your customer's there face to face. You made the sale. And they're like, the bill's $1,000, and they say, I've only got 500. Or you're in the construction, the bill's $12,000, and the customer says, I thought it would be 8,000. Come back next month.
Yeah.
Next month never happens. Remember in the car business?
Yeah.
I'll
Oh,
be back
yeah.
next month. Okay. Nice meeting you, right?
Yeah.
So that's where consumer financing comes into play. The customer doesn't have to leave. You can say, let's finance the balance of it. It's simple. But when you're connected with it, you input the customer's information. 60 seconds later, you've got a credit decision, yes or no. You can have them, you can print the paperwork if you want, but it's easier. You can just have them e-sign on a laptop or a tablet. The contract is valid. You deliver the merchandise and you get paid the next day from the finance company.
Wow. 'Cause I know when I got an air conditioner in my house, right? And he came out and he gave me the quote and he said, here's what it is going to be to replace your air conditioner. And I remember him having information too, saying like, this is obviously the total if you write a check, but you can also finance if you want to finance.
Mm-hmm.
So in that sense, does it cost the business owner anything if I finance?
It does.
Okay.
Yeah. And
Like,
it's an interesting,
is it?
it's a percentage. It's an interesting matrix. And it was that way in car sales also. They did that with like special finance deals. The dealership literally had to pay to get the deal bought. But it's the same setup. That's why you'll see businesses offering cash price. Here's what you get, here's what you can buy for if you pay cash, and here's the price if you finance it. That's how you compensate that loss, gain back some of the money that you're paying.
I see. So then I pay a percentage, right? So I pay a percentage to the bank who's financing this 90-day term, but then the next day when the deal closed, I actually have my money in my pocket from them. And then they're releasing it. The customer is paying the bank.
Yeah, the customer makes the contract with the lender. So even if the customer defaults, the business owner has no recourse, no deal. It's between the lender and the customer.
Oh, okay. All right.
And you do pay a percentage, but like when you swipe here's the best case scenario. So for a business owner, if that customer is there buying something, if they pay cash, that's the best because you get all of it.
Always, right.
Yeah. If they swipe a credit card, you're paying 2 or 3%. That's the second best case scenario. What financing is for is it's designed to increase sales. So you're still going to get your percentage of customers who pay cash. You're still going to get the same percentage of customers who swipe a credit card. But when you advertise 90 days, same as cash, more people come in. And even though you're paying a discount, like you're selling it for maybe like 88 cents on the dollar, the bill's $1,000, you'll get $280. And that can be compensated by adjusting the price upwards for somebody who's going to finance. Here's your cash price, here's your finance price. Which do you want to do? And it always boils down to payment anyway. So most people are going to be like, I'll pay another $100 for it. Just finance me for a year.
Yeah.
And 90 days same as cash is attractive when you advertise it. So you'll still be making the same amount of sales from your cash customers, same credit card customers, but the people who are coming in due to finance, that's new business. That's more business.
Right. And you're providing so many options too. So, it's hard to get it. No.
Well, and if you don't provide it, the guy down the road's providing it.
Right.
Very
true. Yeah.
I call on lots of construction companies and contractors, And it's surprising to me that I'd say about 30% of them still don't offer financing.
Wow. So what is this called? If somebody was interested, if somebody that's listening has a roofing business, right? And they're like, you know what, I want to be able to offer my clients this 90 days, same as cash. What
Yeah.
is this called? What do they,
It's just business to consumer financing.
is that what that is? Okay.
Yeah.
All right. Good deal. Now talk to me about factoring. You mentioned that earlier.
Mhm.
What is your factoring program?
Factoring, there's an interesting history to it. It's been going on since like centuries ago. Okay.
Okay.
So if you are business to business, you are a manufacturer and you're selling your product to any other manufacturer who's going to turn it into something else. But business to business,
Okay.
after you deliver your service or your product, then you're giving them an invoice. And that invoice always says 30 days to pay because that's industry standard. If you're not giving them 30 days to pay, they don't like it because everybody else does. So that's
Right.
you're boxed into doing it, right?
Yeah.
So you give them the invoice and 30 days to pay. Well, 30 days is a long time to wait for your money. And in the meantime, while you're waiting, you're still paying salaries, employees, you're paying taxes, you're buying supplies, you're creating product for other customers. You're even paying the truck to take the new products you created to the other customers while you're waiting for your money.
Right.
Businesses operate like that and they get used to it because, they've got enough of a cushion, but they get used to it. But there's a different way. And this way is extremely important for growing businesses and startup businesses. I think I told you the story when we talked the first time. I stopped and spoke with a trucking company owner, and he does $60 million a year in sales. And I told him about factoring. You can get your invoices paid the next day. He says, I don't need it, Paul. I'm super rich. And he was super very nice. He gave me time. He spoke with me, gave me advice. He was a great guy, right?
Yeah.
But he says, I know exactly what you're talking about. I've seen it, and there's a big need for it. It's just, I don't need it. Now, he doesn't need it because he's flush with money, right?
Right. Super
But
rich.
yeah, yeah. But if you're not, and you're struggling to pay the bills or everything's tight, then there's a product called factoring. It's easy to do. We set you up on an arrangement with a factor and you create the invoice. You send the invoice to the customer and you also send it to the factor. That factor is actually purchasing that invoice from you at a discount. So
Okay.
what's the discount? How much am I going to lose? It's not a
Right.
whole lot, really. And when you compare what you're paying or discounting it for, you're gaining that much more with having the ability to run your business strong with cash and buy things at deeper discount. You can buy supplies at deeper discounts if you're paying with cash immediately than you are, if you're waiting to pay them.
Right.
But so you submit the invoice to them, and the next business day, they will advance 90% of that invoice into your business account, which gives you the money to operate your business. If you're a growing business and you got more orders going out and
Right.
your cash flow is slow, that's not a happy medium. You gotta make it work somehow. If you got so much going out but not enough coming in, that's going to be a problem.
Yeah.
Factoring solves that problem because now you're getting 90% advance the following business day as soon as you submit that invoice, right?
Right.
What about the other 10%? Where's the rest of my money?
I would think that the factor gets it as a fee.
Oh,
No?
oh no, not that much. That would be crazy.
Oh, but I don't know.
They
So
get
where is the 10%?
so it comes back like when your customer pays that invoice, they're actually paying the factor through a PO box. Okay.
Okay.
And the factoring company collects the other 10%. And depending on how long it took your customer to pay the invoice, like if it's 30 to 45 days, they might charge you 0.75% or 1%.
Oh, okay. Those
So
are better numbers.
yeah, better than 10%. I wish it was 10% because I got to cut it back.
I don't know. Those are
Let's
much
go
better.
your way.
That's why I'm not in financing.
Well, no, I think you should be. But so you get advanced 90% of your money. You got all the money you need to operate on. You've got 90% of what you're owed. That's a big deal. That's a lot of money.
Yeah.
The
definitely.
other 10%, if it takes 30 to 45 days for your customer to pay the factor, then it's going to be, 0.75% to maybe 1%. If your customer does not pay that invoice for 60 days or 75 days, and that happens a lot,
Yeah.
then the discount, the fee goes up. So it might be 2%.
Okay.
But the numbers aren't big. If you have a $10,000 invoice that you submitted and you're getting 98% of it, you're getting $9,800. And you paid $200 so that you could get 90% of that money up front to keep your business going.
I get it.
Yeah, it just gives you the money that you need to operate on.
Yeah, I can definitely see that this in the construction industry. My family has always been in some, and a lot of my friends as well, in some form of construction. So I know it's like a 30-day delay, right? Contractors never pay. It's always late, but I can see how this could really benefit them because, you're selling it, you're losing a small percentage, but you've got that money already in your hands to keep your business going and growing, and you're not waiting for someone to pay their invoice.
Right. And it's an expense that can be written off. So you're not even really paying it.
Oh, okay. I didn't even think
Right.
so. You could write that fee off.
Yeah, because it's a fee. You're paying it for a service.
Interesting. I love this. I love hearing all this. What's the most common question you get asked?
Oh boy, can you get me financed?
So what if, can you? What if you have bad credit or you're less than that 2 years in a business? Is it still possible?
Definitely. Here's why. Like we were talking earlier, the local bank has their kind of rigid set of programs. If you don't plug in, then you're not getting plugged in, you're out.
Right.
There's lenders who recognize that it's not a perfect world, and that's their specialty, is getting people with difficult or damaged credit financed. Because you own a business, you need the equipment that you're trying to get a hold of, or you need the financing program. You're not applying for it because you want it, you need it.
Right.
And there are lenders that recognize that. Now, of course, you pay a higher rate, of course. We all know that. Just like when you buy a car, less credit, more interest.
Right.
But it's not that crazy at all. And if you're a guy, I'm going back to the construction, but let's go with restaurant this time. You're a restaurant owner.
Okay.
You need new equipment or you need working capital. We can get it done for you. If you have damaged credit, you're going to pay a higher rate. But 2 years later, after you've made all those payments, you're not damaged anymore. You're made better. You're made whole. Your credit's better, and you don't have to worry about paying higher rates. But the initial hump is that you just got to get approved somewhere first.
Right.
And check this out. It's called revenue-based leasing. So construction, restaurant owner, manufacturing plant owner, anything, they need a new piece of equipment, right?
Okay.
They need it. They want to get it for their business. It's going to improve the efficiency. It's going to improve the income. That's going to be a valuable addition. But they got turned down at their bank. So how am I going to get that done for them? I'm going to use a revenue-based leasing company. And what they do is they look at the whole deal, they see the credit, and they say, okay, they look at that and they say, well, he's been in business 10 or 15 years. There's hiccups, things happen. They look at the income of the business. If that business is making a lot of money, and I can verify that and prove it with 3 months of bank statements that show a lot of money coming in.
Yeah.
That's this much of the deal. The credit's this much of the deal. They look at the equipment that he wants and there's value to it. Well,
I gotcha.
two out of three parts of the deal are good, and they'll take that chance and they'll do it because he's making the money and he's got the ability to repay. The ability to repay is the most important thing.
I gotcha. Interesting.
Yeah,
That
with
makes
good
a lot of
credit.
sense. Go ahead. I'm sorry.
Oh no, you go ahead. I'm sorry. Go ahead.
No, I was going to say, so don't be afraid to try to get financing. You know,
Totally.
even
Don't be afraid. Yeah.
if the bank says no because you don't fit their criteria, they're a little bit more strict. There are still options to get that financing, to get the equipment. I mean, a lot of options to keep money flowing through your business so that you don't really slow down, which is great to know. So if somebody needs to get in touch with you because they've got questions about one of your many programs that you have, how can they reach you?
Well, you can call us directly, 844-742-1776.
Let me put this in here. Hold on. Say it again.
844-742-1776.
Did you do that on purpose?
Yes, Patriot.
It's Patriot Business Finance Consultants. So I know you're very much like, and you should like pro America. And I mean, you're just Patriots of the 1776. I had to ask, like, is that on purpose?
America.
So go ahead. I'm sorry. How else can they reach you?
You can go to our website, Patriot BFC, B for business, F for finance, C for consultant, but patriotbfc.com. Calling us directly is the best way. We always answer the phone. If I don't, I'm just on the line with the customer and I'll call right back. But you can go to our website, you can click apply and contact information, fill out a short questionnaire, just tell us what you're trying to get accomplished. And we'll call you that day as soon as we get, as soon as we click it and look at it, we'll call you right back.
Awesome. Awesome. Paul, thank you so much for coming on. I love learning all this. My head's spinning a little bit. I can't even lie. There's a lot of information as far as getting loans and financing, but really good information because I think you took a lot of the intimidation away by just explaining that there's options. So thank you so much for doing that.
Yeah, thank you. I'm so happy. Thank you for having me on here, Deanna. I appreciate it.
Absolutely. It was great to connect again. All right, guys. I'll see you next time. We'll see you. Bye.